Yesterday, Morningstar released a valuation on the upcoming SpaceX IPO that seems to have been largely missed by financial media. While reports suggest SpaceX could go public at a valuation approaching $1.5 to $2 trillion, Morningstar's estimate came in at roughly $780 billion. Now, that's a pretty significant difference. What caught my attention is what Wall Street has been doing behind the scenes. Over the past few weeks, major index providers have quietly begun changing the rules. So historically, a newly public company often had to wait months before adding in to a major stock market index. Those rules are being rewritten so that companies like SpaceX can potentially enter into the indexes almost immediately after going public. And that's a huge deal because once a company enters into a major index, an enormous amount of money becomes a forced buyer. Not because investors studied the company or they believe that the company is undervalued, but because they literally have to buy it based on the models. This is what is known as the passive bid. And the passive bid has become one of the most powerful forces driving markets today. Retirement accounts usually buy index funds. An index fund buys whatever is in the index. They don't care about valuations. They buy according to the rules. So if SpaceX enters these indexes quickly, trillions of dollars tied to passive investment strategies become a source of automatic demand. So every paycheck, regardless of valuations, goes into the fund. And initially, that's very bullish. But there's two different ways to interpret what's happening. They understand that valuations today are being supported by massive and largely automatic flows of capital into passive investment vehicles. And they may also understand something else. The very technology that's driving these trillion-dollar valuations could eventually threaten employment itself. Now, in that world, the logical move would be to bring these companies public before the AI begins impacting the employment base that ultimately funds the passive investing machine. Changing index rules to create automatic buyers isn't price discovery. It is market engineering. At a minimum, it's centrally managed markets. At worst, it's creating a mechanism for insiders to transfer risk to passive investors at maximum valuations. Now, I'm not saying to short SpaceX, but when I look at a world where valuations are increasingly dependent on automatic flows rather than fundamentals, and where AI may eventually undermine the employment base that funds those flows, I come back to the same conclusion. I want to own assets that exist outside of the financial system, and that always remains gold. Because if the AI boom continues, gold benefits from the liquidity. And if the AI boom eventually bursts, history suggests policymakers will respond with more liquidity. And gold tends to benefit from that too. So the question isn't whether SpaceX is or going to be successful. The question is this: if AI eventually replaces enough workers, who's exactly left to keep buying the indexes?